Hello, everybody, and welcome to the Nasdaq Dorsey Wright podcast for Wednesday, May the 20th. I'm Jay Gregnani, and here joining me this week is Ian Saunders. And last week we wrapped up, I believe it was the 10th week of officially being in work from home environment in quarantine situation. So we're working on week 11, and coming up this weekend, everybody looking forward to the Memorial Day weekend holiday, which for I would imagine the vast majority of people out there will look very, very different to years past. Ian, I don't know about yourself, but Memorial Day weekend is typically, the weekend of the year that all of the kids look forward to because the pools are all opening up. Very oftentimes, it's a time that many people from here in the Richmond, Virginia area head down to either the Outer Banks of North Carolina or Virginia Beach or the river in some capacity, head down towards some coastline and enjoy cookouts with family and friends. And then so certainly given everything going on with the COVID-19 virus and everything else out there, understandably, this year is going to look very, very different. But, the reality is in the past 10 weeks, 11 weeks or so have looked very, very different for most as the world is dealing with the pandemic. And so, before we get started, Ian, it's certainly been an interesting time, not only navigating the tumultuous, the volatility of the market environment, but, just personally in terms of, shifting from being in the office all the time to working at home, what are the biggest ways that your life has been impacted, or what are the biggest, tools that you've been grateful for to have at your disposal over these past 10 weeks as we've been working from home?
Yeah, I mean, it definitely has been an adjustment here, Jay, and I think that probably my most frequently used tool, or at least now my most frequently used app on the phone, is the food delivery service here in Richmond. No shortage of restaurants likely that are staying open, even if they're not letting people in the doors, staying open for delivery purposes. So Richmond has a pretty decent food scene, and nice to see that kept up, support the local businesses there. I think outside of that, the most happiest individual that I've seen during the quarantine has probably been my puppy dog. He's probably a little bit confused about why I'm around so much more now, but has definitely enjoyed the more frequent walks and attention that he's getting in the work from home environment that we've been in here.
That's great. Yeah, it's been interesting. I can appreciate that. There are some benefits, certainly that have come out of this and will continue to come from it. Number one is for me, doing a fair amount of travel in normal times during the course of the week. I've been home and sleeping in my bed, eating dinner with family and the kids every single night. And so those times and those moments are certainly precious, and I try not to take them for granted. Despite my wife told me the other day, she said, we've been married for 13 years and we were together before that. And these past 10 weeks are the longest consecutive streak that we've been together, or we've seen each other in a consecutive manner. And so it's been, it's been pretty interesting and been pretty unique. But the time with the family certainly has been, probably the best part of the whole thing. But I think I share many others' thoughts in the fact that, while that has been appreciated, I think we can all look forward to at some point returning to a new normal. But the reality of the technological advances that have happened over the course of the past few years are really what is allowing us to be able to work in this environment. We use technology every day to be able to continue to communicate, continue to work. Zoom has become an integral part of our daily lives. Microsoft Teams has become an integral part of our daily lives. And gosh, without those technologies out there to be able to produce these podcasts or chat internally are certainly have been invaluable. So from a business perspective, the technological advances have been paramount in terms of maintaining maintaining the business and being up and running.
Absolutely. And I think that technology there, Jay, as well, has been one of the other big positives that at least that I've seen coming out of this is still being able to spend time with those that you might not necessarily be as close to via stuff like you said, Zoom there. I mean, we pivoted on the business side from we used to record the podcast in the kind of the studio that we had there in the office, and now we're recording the podcast on Zoom. But having grandparents and people really around the world, being able to still communicate with them via Zoom as well has been definitely something to look forward to, given the environment that we've been in.
All right, so I'm gonna put you on the spot here, Ian. What is the one thing that you've done in the past 10 weeks that you never thought you would be doing?
I think that would probably have to be actually exercising the puppy dog every morning. So prior to that, I used to try to the Labradoodle. I call him a puppy. He's about 2 years old now, but he can get pretty rambunctious without exercise. And so actually getting him out and getting him a mile or two run or so in the morning to tire him out so he sleeps for the rest of the day has been something, definitely a bright spot that I was not necessarily expecting here over the past few weeks. What about yourself?
That's great. That's a good question. There's a couple things I'll mention. But first, I know, exercise is a big part of your life. I've known you over the years, and exercise has certainly become a big part of my life over the years. And, I was in a very religious habit of going to the gym every single morning and, before work and getting that in. And then, the gyms closed down. And so, finally my wife had been talking about wanting to buy a Peloton bike for probably 2 years. And so I remember very distinctly the first week in working from home, the gyms were still open, so I could still go to the gym. However, once that changed, that flipped the conversation, on its head. And so we ended up getting a Peloton bike, and she uses it more than I do, but I still try and get on it a fair amount. And I tell you what, it's been great. Working out for me has always been one of those, trying to stay in shape, but just mentally, given everything, the normal stresses going on today, the mental relief that I get out of working out is tremendously beneficial. So owning a bike in my house, I guess I would say that would be one thing that I never thought would actually happen. The other thing I will say is that it was, for me, always an inevitable reality that was going to happen. It just sped things up a little bit, and that was taking the clippers to the top of my head with not being able to go get my hair cut. You know what? We got the clippers out one day, went in the backyard, and gave myself a little buzz cut. So didn't think that would happen anytime soon. Nonetheless, here we are, and it feels good. Don't have to worry about that. It still feels a little weird, even though it's been a few weeks now. But nonetheless, here we are, and I think everybody's managing as best they can, and so we'll continue to push forward. There's it seems like there are certain states and locales that are beginning to open back up. Even here in Virginia, the beaches at Virginia Beach are opened up with certain restrictions coming this weekend. So there are things that are happening and moving forward, and we still wish everybody to stay very, very safe and healthy out there as we continue to move into I guess not quite officially, but Memorial Day for many is kind of the unofficial start to summer. So we're almost there. Nonetheless, while we're moving into summer, the market continues to see some bouts of volatility out there. The month of May started after you saw obviously the tumultuous March recovery in April. The month of May has been, back and forth. The S&P is basically flat through the end of yesterday, not counting anything that's going to happen today. But we have seen some notable developments in terms of action on the S&P 500 chart, specifically given the recent volatility in the market.
Absolutely. And I mean, we're discussing the positive and negatives of quarantine here, and we've seen those positive and negatives on display in the market, as you mentioned there. I mean, the sideways movement that we've seen for this, for the S&P 500 is really displayed well on the 20-point chart. We've got a top out there at 3380 in February. Obviously, market fell off there, moving down to the 2200 level by the end of March, and then showed a pretty significant rally back up towards that 2800 point, and has marched steadily higher since then, but has seen some positive and negative on the signal side. It moved to 3 consecutive buy signals in April, and then gave a sell signal to return to a buy signal. We gave a sell signal there last week on this 20-point chart, actually, just after we moved back to a positive trend at 2940. Moved lower to give a sell signal at 2780 with the market volatility, and then reversed higher over the past week to ultimately climb all the way back up to return to a buy signal with a triple top breakout on Monday at 2960. And then movement this morning has led us to add another X on that chart. They're sitting at a current chart level of 2980. Based upon the intraday information that we have here on Wednesday. So definitely it's a good sign to see that improvement, albeit volatile. But the reversal that we had off that sell signal there does set up an additional support level now that we have at 2780, with further support down at 2740. That was maintained twice in April. So definitely a little significantly away from the 2980 point that we're sitting at here currently, but it is good to see that positive movement there carried to the upside as we head towards the summer months here.
That's right. Certainly, positive developments there from the S&P 500 chart itself. And it's interesting though when you dig underneath the surface, and that S&P 500 chart. Certainly doesn't tell the entire story of the segments of the market out there, and very specifically when you look at the difference this year between, if you take the S&P 500 and you carve out all of the growth stocks in the S&P 500, and then you call out all of the value stocks in the S&P 500, and you put those into 2 different baskets. There are 2 ETFs out there that do this. The RPG is S&P 500 growth. RPV is S&P 500 value. Same starting universe as the S&P 500, but 2 very, very different outcomes in terms of returns so far this year, just year to date. If you look at the growth stocks, the growth index is down about 4.7%. And to put that in perspective, the S&P 500 index year to date through yesterday, through the 19th, is down 9.5%. So growth stocks down about half as much as the S&P 500 this year on a year to date basis. Value stocks, on the other hand, are down 36% on a year to date basis, even with the recovery that the market has seen in the month of April. And I think that is really the big story in terms of the market this year, is just the pure dominance of growth stocks in general and the continued weakness from value stocks. That was the case coming into the month of May. And we've seen even in the month of May that dispersion continue to widen, as just in the month of May, while the S&P again is up about 0.3%, so up about 30 basis points, RPV is down 3.5%, and RPG, so growth, is up 3.5%. So just in the month of May, you've seen another 7% dispersion between the performance of growth and the performance of value, as we've gone through, started the quote unquote sell in May and go away time period, or what historically is the beginning of a seasonally weak period.
Absolutely. And we see that differential reflect as well in some of the underlying technical information that we can see here on the Dorsey Wright platform. I mean, looking at RPG with the recent fund score as of close on Tuesday of 4.92, very different picture when you look at RPV with a fund score of only 0.46. So while both have kind of risen off of their bottom, we've seen much more kind of sustained outperformance there from RPG. That has led to a much stronger kind of underlying technical picture. Again, that fund score is looking at 19 different factors to culminate in that score from 0 to 6, with 0 being the best or worst and 6 being the best. We also see that when you look at the underlying holdings of the 2 funds, right? So take the holdings of RPG and then stack them up against the holdings of RPV, and looking at the top 10 weighted holdings in each fund, we see that all the top 10 holdings in RPG are all strong attribute names with technical attribute scores of 3 or better, right? But RPV presents quite a different picture. when you're looking at the top 10 holdings for RPV, only 3 out of those 10 names have a technical attribute score of 3 or better. So while there are certainly potentially names underneath the hood of RPV that have shown some improvement, that could be areas to look towards, the space as a whole has not shown as much improvement, certainly as that RPG space on the backs of that performance dispersion that we've seen. And part of that has been some of the, because of some of the sector differentials that we've seen there. Is that right, Jay?
That's absolutely right. I mean, when you don't have to look much further than the sector exposures and the differences in the sector exposure of these two ETFs, these two investment styles, to really understand and see the big difference. In RPG, so in growth, the top weighted sector, which is not too surprising, is technology. That's about 35% of the movement of RPG is directly attributable, directly related to technology, the technology sector. And this year, technology on a year-to-date basis is actually up 4%. So again, S&P is down about 9.5%. XLK, which is technology, is up about 4%. Whereas you look on the other side, on RPV, on the right-hand side there, and the top weighted sector is financials. And financials have obviously seen a ton of volatility, more so than the average sector out there this year, more so than the market. The financial select sector spider ETF this year is down about 29%. So you take, basically a third of RPV is down 29% this year, where a little over a third of RPG is actually up on the year. And those are big, stark differences that we've seen in the portfolio. Another big difference, obviously, would be the energy sector. Energy and RPV, so value, is at 13% versus just under 2% for growth. And energy has seen quite a bit of move off the bottom here recently. Has been one of the better performing sectors near term, but still, you look year to date, and energy is still the worst performing sector, down about 37% on a year to date basis. So, the big difference really in, what growth stocks have done this year, even growth stocks within the S&P 500. So we're not deviating outside of the S&P 500. Growth stocks in the S&P 500 have dominated value stocks in the S&P 500. And this is not a new phenomenon. This is not a this year phenomenon. This has been going on for some time now, but this year has just continued to see that dispersion widen even further. And so we can see some of that when we go in and we look at the rankings and the scores of all of these different styles through our asset class group score page.
Absolutely. And so as Jay said there, the asset class group scores page is going to give us some relative comparisons of a variety of different areas, right? We have 135 different groups that we track on the system, and they're going to be looking at, circling back to that fund score idea, the fund scores from 0 to 6, looking to aggregate areas according to specific classifications, and then giving us an average score based upon the funds that are going to be included in each group. So 135 different areas, and here we can take a deeper dive on this page to look at only the U.S. size and style breakdown. And interestingly enough, I mean, we saw growth kind of leading the way for most of the market. Heading into this market decline that we had there in February, growth was still at the top of the leaderboard, if you will, across your large, mid, and small size classifications. And it's interesting to see that has really been sustained. Growth has continued to lead the way, even looking outside of just large cap, looking at mid caps and small caps as well. While they have trailed their large cap counterparts, their growth representatives have continued to outperform the blend and the value classifications that we see here on this page, as dictated by these rankings. And if we take in order to take a deeper dive into some of that large cap growth movement that we've seen relative to the large cap value, we can look at a score history of the graph here on the system, and that really does a great job in displaying a nice picturesque image of the further dispersion that we've seen over the past several weeks. These scores have not necessarily moved in tandem throughout history. Obviously, there's going to be periods of outperformance for value, periods of outperformance for growth, although we've seen most of the last few years be favoring the growth space. The scores were still moving in a similar fashion, albeit different score ranges, but looking at similar directional moves over the past couple of years. And we saw a very stark difference come into play in February of this year, when we saw the large cap value space really begin to fall out of bed, moving from an average score of 3.62 in mid-February, on February 17th, all the way down to bottom out at an average score of 2.22 in March, right at the end of March, on March 30th. On the flip side, growth topped out at quite a high average score there of 4.78 on February 17th, and did fall off as well, but actually never moved south, or never moved south of the 3.5 line, kind of hovering right around that 4.0 score threshold, and is now rebounded back up to a score above the 4.2 range. So we've seen that kind of further dispersion represented here in the score dispersion as well, which is actually looking at the largest score dispersion for these two groups throughout the history of the asset class group scores page.
Yeah, it's interesting when you look at that chart. Since early 2017, that blue line crossed above that red line, which suggested the score for growth is greater than that of value. But even when you zoom and you look on it, since that early 2017 time period, growth has been scoring above value for the better part now of over 3 years. And it's not to say that at some point that value won't come back in favor, because it certainly will. The big question is, can that score continue to push lower? And the answer is, historically we have seen it lower. Back in the 2009 time period, that large cap value score had dipped below the 2 line very briefly. So it's possible. We'll continue to watch and see how the value score plays, and then relative to the growth score, especially because value can be a very important piece of a portfolio at certain times. You go back and you look on the left-hand side of this chart, and since really the early 2000s, this data goes back to about the end of 2003, but even prior, since the early 2000s, all the way until about mid 2007, value funds were holding up much better and scoring much better than growth funds were during that time period. And so, it very much is, value it is and can be an important piece of the portfolio, but we want to see some positive direction, positive movements out of the fund scores, out of the relative strength space, or relative strength perspective from these scores, versus, not even on a relative term, but absolute term, even just in near-term performance, as well as the long-term performance, it continues to favor growth over value. And those growth stocks are, there's the big mega cap stocks. They're the ones that have been holding the market up. They're the ones that have been, doing much better, even to the extent of the Nasdaq 100 kind of pushes that envelope even further into the large cap growth camp, is up on the year. Versus the S&P being down 9.5% so far. So as we look out at the landscape right now, I think one of the biggest stories this year really has been the dominance of growth over value, and how the market has just continued to drive down value stocks and continue to find their way to supporting the growth stocks. And we'll continue to monitor that situation and see how things play out from here.
Absolutely, and one way to kind of further monitor that there on the system. I mean, we've been focusing on the large cap space, given the dominance of large cap in and of itself that we've seen outside of the style classification. But you'll notice on that group scores, that asset class group scores page, that large cap value is the highest ranked value classification that we do have. Even with its 2.25 fund score, it's still best the mid cap value of 1.75 and the US small cap value at 1.23. So for those that might be looking towards this dispersion and say, oh, well, that's maybe the potential for that mean reversion, as Jay was getting at there, the kind of contrarian mindset. Maybe you can definitely take a look at some of the individual fund movement for those that might be looking to play that, but taking a look at the broader rankings for the spaces as well. looking at those respective scores, their directions, the momentum that we've seen there. Looking for some pops in that would definitely be a place to look towards. For those that would, depending upon the subscription level, you could have the opportunity to set alerts there through this asset class group scores page to be notified if any of these groups did start to see some score improvement. But definitely would be one place to continue to monitor here as we head towards the hotter months of the year.
That's right. Well, look, Ian, appreciate you joining us this week, and appreciate you sharing all the insights on a personal level as well as general market thoughts and comments. And to all of you out there, thank you for joining us this week. Hope everybody has a safe and healthy Memorial Day weekend. Enjoy the long weekend. Get some rest and relaxation, and hopefully, we'll be back with you next week. So appreciate you joining us this week. Look forward to talking to you soon, and we'll be back next week.